$55,000 in taxes on $60,000 of stock that might be worthless by April. That's the hidden trap big tech just set for $150,000 plus employees holding 2024 RSU grants right now. You think, if my equity vests but the stock crashes, I won't owe income tax on worthless shares. Wrong. And here's why that matters and what it costs you in the next 90 seconds. Microsoft, Meta, and Alphabet disclosed over 43,000 layoffs combined in 2024 tied directly to AI automation. What they didn't emphasize, those layoff announcements trigger vesting acceleration clauses buried in equity grant agreements. A vesting cliff hits, your RSUs accelerate. Then the stock drops 50-60% in the same week. But the IRS doesn't care about timing. Under Section 83 of the tax code, RSU income is recognized at vesting date fair market value, not the price when you file taxes in April, and not the price when you eventually sell. This is the mechanism that breaks most people's financial plans. Let me show you the exact dollar impact, and it's worse than you think. Take a mid-career engineer at Microsoft earning a $150,000 annual RSU grant. That grant vests over 4 years, roughly $37,500 per year in recognized income. Now, a layoff announcement happens. Vesting accelerates. Suddenly $100,000 plus of your grant vests in a single quarter at, say, $100 per share. That's $100,000 in recognized taxable income the IRS will tax at your marginal rate. If you're in the 37% federal bracket plus 8, 82% California state tax plus 15, 3% FICA taxes on the wages side, that's approximately $37,000 in federal tax liability alone, due by April 15th. Add state taxes, and you're hitting $45,000, $55,000 total. But here's where the trap closes. While those shares were vesting, the stock dropped 60%. Your $100,000 grant is now worth $40,000. You still owe $45,000, $55,000 in taxes on an asset worth $40,000. You have to sell shares at a loss, drain your saving, or take a personal loan just to pay the IRS for equity that's already lost $60,000 in value. You're now $15,000 underwater on the tax bill alone before any future stock recovery. The IRS publication is explicit. Publication 525, Topic 427, states that RSU income is taxable in the year of vesting at fair market value on the vesting date. It doesn't adjust for subsequent price declines. It doesn't care if the company laid you off the same day. The number is locked the moment the shares vest. Now multiply that across the numbers. Meta's 21,000 laid off employees, Microsoft's 10,000, and Alphabet's 12,000. That's 43,000 workers holding overlapping 2024 RSU grants with similar vesting schedules. Thousands of them are facing identical $40,000, $55,000 tax shock. If layoff waves continue into Q1 2025, which analyst consensus from JP Morgan and Goldman Sachs suggests they will, we're looking at a cascade of vesting events tied to stock price collapses. This isn't speculation. This is structural. The real shock comes in April 2025 when workers file taxes and realize they're liable for $40,000, $55,000 in federal taxes on equity worth $35,000, $40,000. That's a 15-30% negative return on compensation they earned but never received in cash. But here's the one detail most people miss, and it could have saved you $12,000, $18,000, Section 83B elections. If you file a specific IRS form within 30 days of receiving your grant, not vesting, receiving, you can lock in a lower tax cost earlier and avoid the vesting date cliff entirely. You'd recognize income on day one when the stock was worth $80 per share, not on acceleration day when it's $40. But that window is already closed for most 2024 grants. Most employees didn't file it because they had no reason to think about it at grant time. HR didn't mention it. Your company's equity plan documents buried it in footnotes. The delta is brutal. You're facing a $37,000, $55,000 tax bill on equity that's now worth $40,000, $60,000. After taxes and broker fees, you've effectively lost 70-90% of your grant's value in a single quarter. If you're a tech worker holding RSU grants from any of the big three, or any company with layoff uncertainty, you need to model this scenario with a CPA or tax professional now, this week, before any vesting event. Don't wait until April to realize you owe taxes on worthless equity. For the full tax calculation breakdown and the exact IRS form references, the deep version with spreadsheets is in the companion guide. Link is in the description. If this opened your eyes, subscribe. I'm covering Section 83B, election timing, and how to restructure equity grants to reduce tax shock in the next video, dropping Thursday. Ring the bell. What's your biggest takeaway? Drop it in the comments. In AI, the early reader wins.